What's up, everybody? With how volatile the market has been lately, I just wanted to give you a quick update of what I'm doing with my money. So I actually have two portfolios. So the first one actually is about almost $28,000 of just short-term treasuries. These pay me about a 5.3% dividend, and it's risk-free. So I just park all my extra cash in there, and it pays me about like 130 to 125 a month, and I just roll that over into the main portfolio. And so that's what I wanted to talk about more about today, is the main portfolio. So right now, my main holding is an ETF called DGRO, which is a dividend growth ETF. This one holds companies that have paid a dividend for 5 consecutive years plus, and it has about over 400 companies in it. It's just an umbrella to catch all the dividend stocks that I focus in on. But if we look down here, one of my main holdings is VG Properties. This is a real estate investment trust that we'll dive in further along. Then we have another 3,600, about 8 shares into MasterCard. Then we have 14 shares into Union Pacific. We've got another 10 shares in Apple, another 10 shares in Google, another 10 shares in Nike, and then another 10 shares in Starbucks. So I wanted to talk about why I own each one of these companies. Right? So the first one I talked about was VG, right? This is one of my main holdings. The stock price right now is $27, and I have its fair value at $34, and my portfolio price is right at $30. So VG is an undervalued real estate portfolio, has excellent management strategy. All deals have to be immediately accretive to AFFO. And then they have secular growth trends around experiences over goods. And Las Vegas continues to diversify away from gambling into sports. So if you didn't know, VG is a REIT, like I said, that owns a lot of casinos in Vegas. So they own Caesar's Palace, the Venetian, and a lot of other gaming properties. So with more of a shift to experiences over goods, VG should see a benefit. VG's getting crushed right now because of interest rates going up, just like any real estate property. But that's going to be continue to hold. It pays over a 6% dividend yield, and it's a great value right now. And then the next one is Nike. So Nike is at a stock price of $93. Its fair value, I calculated it out to be $102, so slightly undervalued still. And my portfolio price is at $90. So some highlights about Nike. It's a durable brand with dominant market share in apparel and footwear. With teens, it has 59% market share in shoes and then 37% in apparel. They have one of the main reasons I'm attracted to it is because they have a strong push for innovation from management, and they're leaning heavy into sports. And they're also laying out the foundation to return back to growth. So right now they've been kind of stagnating, and they're laying out the foundation so they can return back to that mid or high single digit revenue growth, right? And they're also sitting about $12 billion cash, so they're financially stable. All right, the next one is Union Pacific. So Union Pacific's stock price right now is about $230, and their fair value is $205. My portfolio cost is $197. So one thing that you'll notice is a lot of my portfolio cost is below my fair value. That's how I try to buy stocks when they're undervalued. So it's a mission-critical, durable business, extremely hard to disrupt. It's a railroad. You can't just go and build another one. You can't really compete with them, right? Cost-effective and convenient way to move bulk goods across markets. Headwinds of less being goods sold, right? Like I said, same thing with VG. People are shifting more to experiences over goods. Obviously, Union Pacific ships a lot of goods, so they might be affected by that. And then they have a dedicated management to getting the operating ratio down, right? And then Jim Vena, now on as CEO, has a proven track record. He used to work for the company, and during that time, he drove operational ratio up, which is really good for railroads, or down, I guess I should say. But that's a hold. Right now, it's at 231. And my fair value is at 205. And then MasterCard, my highest conviction. So stock price $458, fair value around $460, portfolio cost $398. So MasterCard is one of those that's just almost a no-brainer, right? It's a toll road for digital spending. As the world economy and especially the digital economy grows, MasterCard basically is a toll road collecting fees on top of that, right? As a vast network adoption across the road, secular growth trends of less cash transactions. So every time somebody uses their MasterCard, they obviously MasterCard gets a little bit of money off that instead of using cash, right? an extremely capital efficient business, right? It takes no overhead really to process these transactions. So basically all that money flows to the bottom line and to people like me as a shareholder, right? And then we got Apple price at 173. It's fair value. My calculation 150. Its portfolio cost around 140, right? Obviously, it's a dominant market position. 85% of teens have an iPhone. 2.2 billion active devices worldwide. Extremely sticky Apple ecosystem. Growth driver, secular revenue. High margin products, obviously, with services. Headwinds of Apple Store tax being 30%. A lot of people have been knocking them on that. They want to get that 30% tax lower. So obviously, if that were to happen, it would impact their margins. And they're also sitting on $120 billion cash, which is, needless to say, a lot of money to be sitting on. All right, and then we got Google. Stock price 155, fair value 150, and its portfolio cost to me is 130. So obviously Google, dominant market position on search, 90% market share in that search category. YouTube, secular growth trends around more and more young viewers moving to YouTube, right? And obviously the younger, you're going to have the longer lifespan that they're going to watch YouTube. As more of the economy is digitized, Google will be able to monetize more and more ads on their Google platform. Headwinds of company culture, innovators dilemma, and then what the innovators dilemma is AI, right? Do they shift more to this AI product that hurts their core search business, or do they continue to just basically the printing or the money pressed down in the basement, right, of ad search? Do they just let that continuously run and make more and more money, right? They're also sitting on $100 billion cash, which they're in a net cash position. They're not going anywhere. They're extremely financially healthy. And then we got one of the more recent additions to the portfolio. We got Starbucks. So Starbucks is stock price is $85. Its fair value is $92, and the portfolio cost to me is $86. So Starbucks has global brand recognition. Obviously, it's the number 2 restaurant for teens. It's a highly addictive caffeine product, right? You're going to have to continuously go day after day to get that Starbucks itch. Growing mobile and rewards apps. So this is huge for the Starbucks story, right? When you download this app and you preload money onto it, it acts as a interest-free loan to Starbucks, right? Because you give them the money now, and they actually don't have to provide the product till later down the line. So they take that money and invest it into new stores with basically a 0% interest rate. And then that's part of the reason that they're able to have an industry-leading payback period on new stores, around 18 to 36 months. And they're also growing same-store sales worldwide, which is really what you want to see for a restaurant stock. So that's what is in my portfolio now. A couple of the companies that on my watch list that I want to highlight are, obviously, we got Rollins, which is a pest removal company. We got Texas Roadhouse. We got Costco, Microsoft, Lockheed Martin, McDonald's, Otis, S&P Global, Lululemon, Chipotle, Pepsi, Netflix, Monster, American Express, and Ulta, and Meta. So all these are really, really good companies that I hope to own in my portfolio one day, but they're just a little bit too expensive valuation-wise for me to actually add them to the portfolio yet. But the one that's pretty close down here would be Lulu. I considered adding it to the portfolio this week, but just didn't pull the trigger. But I'm hoping to build, if we go back to my main portfolio this week with earnings reports and all that coming out this week, I'm sitting on a big cash pile that we talked about, right? Almost $28,000 that I'm continuously lowering that cash position and and distributing that into the some stocks that I like. And so hopefully we see a dip this week, right? I'm trying to load up on MasterCard. That's one of those that you're going to look at 5-10 years from now and just like it's a no-brainer. As the world economy and digital economy grows, MasterCard is just going to continuously benefit it from that. So I hope you liked the little portfolio update. I know it's been a while since I've been on YouTube, but I'll catch you guys in the next one.